obviously Tuesday. We got Pal speaking in less than 15 minutes. And right now, we're just chilling. Chilling. If y'all in any trades, let me know. I did add money to the account just because I was like, you know what I'm saying? I'm gonna just start managing the risk properly, and it's about time. I met this dude and I was talking to him, and he was like, "Bro, you got the same thing," and y'all say the same stuff. I say the same thing. I'm like, "Bro, yeah, I could do this stuff, so let's do it." I don't know if I should just restart it or I'm gonna just put day trading for 1,000 today, just because it's not necessarily anything. I like that still for calls. Calls still look very good here. Just needs some type of retest after. It could retest now too. Sure. But I think it'll have to be quick. Wait. 650. I put 650 because we was at like two something. So we slightly. Yeah. I'm trying to play off of J Powell. Here. How's the strat with you and Clutch going? Well. We die off here. Be weird actually. Oh, how? The fuck is that? Oh, we went down a little bit. I'm gonna say what the fuck. I mean, what? So we did that to people. I don't know. That's kind of weak. If that was to close under that, that's like weak as fuck. After just trying to pump some shit, you know what I'm saying? Wait until 10. That way you can see how the market gonna move. Going splendid last week or two, been a little booty, but still green. That's funny. But hey, that's good. I like that. I like that. I'm glad y'all fucking with it, or you're fucking with it, and it's working for both of y'all. I'm gonna make sure I'm not quiet. Y'all can hear me well and shit, right? And stiff. Let me see. 5. Let's get to 116. That's if we get to 522. These could get to 166. Let alone more. Yeah, I'm not really paying attention to the meme stocks. I know I'm probably missing out on. Now, actually, why not? Why not? Mm. Oh, it still went up, I guess. I'm about to say like 2 to, yeah, like whoever had the stuff in the morning probably banked. Damn, nose went to 80. They're probably trying to get people again. Okay, I like this cut now because we actually retested this time. So if we were to go back up, that would be very takeable. But we still got 6 minutes to power. Spot is the most fickle stock ever. Look at, man, I'm about to start trading Tesla. It's got the momentum again. It's looking like old Tessie. She's got a new engine or new battery. She's got a new battery. Apple looks weird. I mean, it looks like it's going down, but it's up. So that could like reverse any moment and be like, we still blah blah. Huh. 5 minute. My bad. I haven't been reading chat. Do Starbucks and GameStop? Do Starbucks and GameStop Johnson and Johnson? Oh, I didn't look at Starbucks or Johnson. Are you saying look at Starbucks because it's like a low, you know what I'm saying, like a slow ticker, or something else, because that's not pumping nothing. Yeah, I think that's what you're trying to convey, because these aren't like volatile. Okay. Do you have a gap anywhere? Making sure. That could be quite interesting. Look like the sellers are coming. Yeah, because if it's going right, it's going green. And if it's going bad, it's going red. Gotta keep it all the way simple. Besides the chart. And the only reason I changed my chart because Pyro, he had like a color combo like this, and I was fucking with it. Oh, we got Powell in a couple seconds. Oh, I got hella shit. I'll just delete it. But it just takes so long to delete stuff. Alright, but this about to explode. Watch that. It looks like it's about to tank on the 3 minute. It looks like it could break like down like this. But I want upside. But yeah, it just looks like it's retesting to go down. Man, I'm talking about the chart thing that's red and green. What's it called? This is the MACD, bro. I don't know what else you want. Or you mean this? Because that's also red and green. It's a lot of things red and green. But that's just, or these EMAs red and green. Or I'm just confused all around. Bro, what is that red and green indicator called? I know, told me last time. Yeah, I think that's the MACD, what you're thinking about, talking about. Not the volume, just the thing you just put up. Yeah, this. Yeah, that's the go in the second position thing, and that's just a long position. It just track like if I was in a play, you see like this little thing is showing. It's like going with it. That's all it's doing, and it don't. You know what I'm saying? At least Webull ain't set it up that way yet. It don't close your positions or anything. It's just visual, but it's cool. Bruh, it's right here. Pause the stream. Look at it. I just told you. I don't know what it's called. It's only called this. It depends on what side you're on. Come on. Oh, I want to see if Powell's talking. So we're going to listen to Powell. Try to listen to Powell.
Those matchups that you really
League of Legends.
Those matchups that you really like, but of course we know that Carrier plays it with anything. But also
live. There you go. Can y'all hear that? Can y'all even hear the stream? Oh, I'm gonna take a position though. Wait, 5 minutes. Yeah, okay. I'm comfortable with doing that.
MP dub dropping.
I'll probably just do one though.
AMC chilling. Yeah. I mean, the thing is, like, I know MP is not running up 100%.
Damn, Tesla.
I'll take the 11, man, after the 15 yesterday. So if anything above $6 is the pressure we want to see.
Yep. So it's looking like.
So we'll find out.
I almost got caught. Almost got me.
Yeah, Power getting introduced. I got it up.
Makes recommendations about the international financial system. Also, he's a professor.
That's damn near a
monetary
W
stability.
short.
He's talking about Powell. Like, why did he don't need an introduction? He's your own Powell. GME back.
Here, I'm gonna try to look for somebody else that's like not talk. And no offense to bro, I just want to listen to Powell. And let's see. Oh, we might be able to look at it right here. I don't think. I don't know. They made this impossible to find. Okay. Alright, I guess it's whatever.
1070. Roku's been going up all day, and gold, man. Gold has literally been on a mini tear here for some reason. Dude, gold's at 2360. Actually insane. And then NASDAQ futures barely red, but the NASDAQ itself is green. And then Russell's up 1.1, SPY up 0.1, Dow doing 0.2.
I really think that's it, y'all. Oh, here he is.
Oh, Powell.
We had growth last year of just over 3%. Quite
Powell,
a strong
U.S.
year.
economy is performing
and
well.
It's driven by a number of things. I would point to a very strong labor market where you've got rising employment, you've got rising wages, so disposable income. Consumers are spending. Generally, households are in good shape financially. They're not over-leveraged.
I wonder if he'll say
And
anything
so
about
we
PPI.
see a good picture.
Remember, if
Consumer
he says
spending has held up
something
very well.
good or
As well,
bad,
business investment
we
has been
have
strong.
big data
Businesses are seeing
tomorrow.
opportunities to
So
invest,
factor
and
that in.
That has helped. I would
What's
also
his
point
gold
to
ticker?
Who's peeing?
How
large
Did
you hear that?
Yeah, how are you watching it, guy?
immigration into the country over the past couple of
Who's
years.
breathing? That's not me breathing.
And
This guy behind the
those people are
camera is
joining
just
the labor
pissing and
force.
drinking.
We're experiencing
right?
still a labor
fuck
shortage
is he doing?
in many industries, and so there are jobs, and they're going to work and they're consuming, so that's also boosting growth. So overall, a good picture looking at the data so far. The labor market is very, very strong. It was, I think, overheated a couple of years back, and what we've seen is it coming back in gradually into a better balance over the last couple of years. And now I think if you look at a broad range of data, you could say that the labor market is about as tight as it was before the pandemic in 2019, and that's good. Wages real wages are now positive, and unemployment has been below 4% for 27 consecutive months, something that hasn't happened in half century. So labor market very strong, and again, signs of gradual cooling and rebalancing, so that supply and demand of workers is coming back into
what do you mean you can't hear
balance, just as we would want. Inflation, it's worth starting with the fact that
now
on a 12-month basis, headline inflation got as high as 7.1%, is now down to 2.6%. That the labor market is about as tight as it was before the pandemic in 2019, and that's good. Real wages are now positive.
I think
and
I want to
unemployment has been below 4% for 27 consecutive months, something that hasn't happened in a half century. So labor market very strong, and again, signs of gradual cooling and rebalancing, so that supply and demand of workers is coming back into balance, just as we would want. Inflation,
we'll just buy one.
It's worth starting with the fact that on a 12-month basis, headline inflation got as high as 7.1%, is now down to 2.7%. Core inflation got as high as 5.6% and is now at 2.8%, so it's down by half. That progress, though, really happened over the course of last year, particularly the second half of last year. The first quarter in the United States was notable for its lack of further progress on inflation. We had higher readings in the first quarter.
Look,
and
this is the thing that you're asking about.
We did not expect this to be a smooth road, but these were higher than I think anybody expected. And so what that has told us is that we'll need to be patient and let restrictive policy do its work. If I turn to the outlook just for a second, I would say we expect continued growth, 2% or better. We expect the labor market to continue to be strong.
What is the gold ticker like? I don't know what that is.
And I expect that inflation will move back down on a monthly level.
And I'm counting in a
trade monthly basis to levels that were more like the lower readings
but
we had last year.
If you can figure out the
ticker,
put it in the chat, and I'll make like one of
readings in the first 3 months of the year. So, we're just going to have to see where the inflation data fall out. And I'll stop there with you.
Let me look at the new layout.
Thanks very much.
Y'all messing with the new layout? I know someone did say they liked it yesterday, but you know what I'm saying?
President Knut, could you maybe give us a little bit of a sense of how you judge the state of play in the Eurozone and here in the Netherlands?
Damn, so we only got to 80.
Yeah, I think the state of play in the Eurozone is not entirely comparable to that of the US. We just came out of more than a full year of economic stagnation. Now, luckily, the signs of recovery are clearly there. We started off the new year much stronger than we had expected. And if you look at the soft indicators, that recovery is expected to continue into the second quarter, and it's even expected to accelerate in the second half of the year. And this is mainly on the back of ongoing recovery in real wages, ongoing recovery in purchasing power, and strong consumer demand. Now, there are two ways in which you can look at this recovery. Of course, you can say, on the one hand, the economy has proven to be resilient. We've went through quite a number of shocks, monetary tightening, unprecedented, and yet we did not really go into a recession. The sacrifice ratio of the disinflation process that we had to go through was virtually zero. Unemployment did not budge. So resilience was there. But on the other hand, the growth was clearly not as abundant as it was in the US, and that is clearly remarkable. Now, I think there is a multiplicity of factors behind this growth differential, but if you allow me to single out the two most important factors in my view, first of all, fiscal policy. And this was not only about the size of the fiscal stimulus, it was also about the design of the fiscal stimulus during the pandemic. In the US, there was a choice for temporary layoffs, income support, and then rehiring when the economy reopened again. Well, that means that a lot of labor reallocation took place, and we know that such reallocation is very productivity enhancing. But in Europe, we chose a different approach. We chose an approach that was focused on job security. The governments essentially took over the wage bills of the firms. And as a consequence, we froze the supply side of our economy for a couple of years. Then during this period of stagnation, there was a lot of labor hoarding, which means that we have gone through a number of years where there has been hardly any labor or, for that matter, capital reallocation. So we have not enjoyed these efficiency benefits of reallocation as much as the US. And secondly, the economic impact, the negative economic impact of Russia's unjustifiable invasion into Ukraine were of course also much stronger on this side of the Atlantic than in the US. We are a fossil fuel importing area, so it meant that this was a very strong negative terms of trade shock, and this terms of trade shock of which we are recovering still also today. Now, on inflation, I think the picture is that I'm increasingly confident that inflation will decline towards our 2% target during the remainder of the year. This is mainly on the back of goods and food price inflation that is coming down. Services inflation has been resilient for a while, but we're now also seeing the first signs of improvement there. And that has everything to do with a slow but gradual moderation of wage growth, which is quite essential, I think, also going forward in making an assessment of inflation risks. But all these developments clearly point toward further disinflation.
It's so beautiful, isn't it?
Also here, an intriguing question is, of course, is there more similarity or are there more dissimilarities with the development in the US? From the onset of the inflation shock, it was clear that the balance of root causes between, let's say, positive demand shocks and negative supply shocks was different in Europe from the US. The US had a much stronger demand component. I think we had a much stronger supply component. Yet at the same time, there was a remarkable synchronicity if you look at the development of actual inflation. So the bump that you've been seeing in the US, the question for us now is, are we going to see such a bumpy development as well? So far, we've not seen any evidence of it, but that's clearly a warning signal for us, also not to come with any sort of premature declarations of victory. All in all, I do believe that inflation is probably less persistent in the euro area than in the US. And that leads me then to conclude that if we manage to continue on this track, if the incoming data continues to validate this development, that it will be appropriate for us to gradually take our foot off the brake, to remove some of the restriction, the monetary policy restriction that we're currently imposing on the economy. The data that needs to confirm this, a lot of that will be available at our June meeting. We will have an additional data point on the labor market coming out next week, the triangulation between wage growth, productivity growth, and profit margins, which is important. Then we will have new projections. And I'm confident, again, that if they confirm the picture, as I just sketched it, that June will be a good opportunity to make a first move in removing restriction.
Okay, very clear hint at June there. We'll come back to whether we could see further moves in July too. But just to draw on some of your comments there, you seem broadly confident that inflation is going to prove less of a problem in the Eurozone than it seems to be at the US at present. You know, we've seen quite a reasonably high PPI reading today from the US, Chair Powell. Some people have said that looks hot. What do you think of today's reading, and more broadly, is there a risk that inflation becomes a lot more of a problem in the US than it is elsewhere?
So we had a producer price index reading just a couple of hours ago, and I would say it's actually quite mixed. The headline numbers were higher, but they were backward revisions, and we're of course disassembling it, taking it apart, and looking at it. And I think markets and analysts are looking at it as I wouldn't call it hot. I would call it sort of mixed. But in terms of the overall picture for inflation, I think you have to go back to last year, where we had historically fast disinflation. Inflation came down by two full percentage points last year. Why did that happen? It's really two forces. working together. One of them is just the reversal, the unwinding of the pandemic-related supply and demand shocks. So that we thought we would always get that. We thought we'd get it in 2022, and we didn't, and then it really arrived in 2021. So that was a big part of this, was just the reversal of distortions, really, to both supply and demand. The second thing is just restrictive monetary policy, and restrictive monetary policy cools the economy and makes room for the supply side to heal, but also lowers demand and ultimately lowers inflation. So I do think those two have been working together. And the question you ask is inflation going to be more persistent going forward? I think, and that would essentially mean that we've gotten the supply side gains that we're going to get, and now it's down to lower demand, which would take longer and potentially be more painful. I don't think we know that yet. I think we need more than a quarter's worth of data to really make a judgment on that. We know that there are still, businesses still report that there are shortages and labor shortages and things like that, which are now being addressed. In addition, even when the shortages are alleviated, there should be lags before that shows up in economic activity and inflation. So there may be some more there. I don't want to give up on it yet at this point. I also think that, having restrictive policy, we have the highest interest rates in some time. I think that it may be that takes longer than expected to do its work and bring inflation down. I am confident that we will do that, but that we will get inflation down to 2%, and ultimately we will do what we need to do with our policy rate.
And just to bring in a question that one of our members of the audience
Chair Jay Powell and ECB Governing Council member Klaas Knot speaking at a special event organized by Netherlands Foreign Bankers Association. Claire Jones from the Financial Times is moderating.
Entertain the possibility that returning to the 2% target will not be possible with the current level of the Fed funds rate?
So I think, as I just mentioned, I do think it's really a question of keeping policy at the current rate for a longer time than had been thought. I think by many measures, the policy rate is restrictive. The question is it sufficiently restrictive? And I think that's going to be a question that time will have to tell. Entertain the possibility is, that could be a very small probability, but I have said that I don't think that it's likely, based on the data that we have, that the next move that we make would be a rate hike. I think it's more likely that we'll be at a place where we hold the policy rate where it is.
And is there any particular component of inflation that concerns you? A lot of people in the US have been focusing on housing and that segment, but is there that, or is there something else there?
So we think of it in three buckets, the first of which is just goods inflation, and goods inflation was negative for 25 years, mildly negative, because of course globalization and many goods were manufactured elsewhere and shipped at lower costs. So that, I think, is performing broadly as expected over time. We had very high goods inflation at the beginning of the pandemic because of the supply chain issues. That came down a lot, and I think we expect that. Housing inflation has been a bit of a puzzle because current rents have been low. Current rent increases have been low for some time, but they're not showing up. That's not showing up in rollover leases and in owner's equivalent rent. So, I think what we've learned is that the lags between a decline in market rents and it showing up in the measured inflation for housing services is long. Their lags are longer than we thought. But as long as market rents don't go up, as long as they're going up at very modest levels, it will show up. It's just a question of when. I think our estimate of the lags is there. And so you've got to look at that. That may affect your confidence, but we have to wait for it to happen. In terms of the biggest part of it is services inflation, non-housing services, and that's more than half of the index. And it's less interest sensitive. It's very sensitive to wages and that kind of thing. We had made some progress there. Particularly if you look at the market-based aspects of it, but that's the one that I think may take the longest. At the same time, it doesn't need to go to 2%. It wasn't at 2% before the pandemic. You need the three of those to come out in some way that they're at 2%, and I'm confident that we will get there.
Excellent. And just to go back into this theme of divergence, I mean, to summarize your answer, it seems that you think the geopolitical aspect of the Europe being closer to Russia, and also the aspect of not only the scale, but the design of the fiscal response, are the primary drivers of this divergence that we've seen between the US and Europe. Chair Power, what would your thoughts be on this? Are there other factors that you think are worthy of consideration when trying to understand why the US and Europe seem quite different economic beasts at the moment?
So I agree with all of the factors Klaas laid out. I would add we're probably also benefiting from a sort of a strictly accounting GDP standard from new workers coming in to a large extent. I think the issue really is, and this is an issue that that the European economic policy makers are very focused on right now, is over the longer run.
I want to see if we pull back again
productivity
for like
growth
a
has been
cleaner
about half
setup,
of
but
the US.
I do want to try
And
for.
so ultimately,
Actually, I
all
can
you've
buy
got
one right
is
now.
hours worked, and that's largely a function of population, hours worked, and then output per hour. That's going to be your economic activity and growth. And so productivity is, really the thing that can enable living standards to rise over time. And there
waiting on
are
like a retest.
theories on why that might be. I think from an American perspective, I would tend to point to the more flexible labor market, and also a more fully built out set of capital markets, which is parts of which are very focused on funding early stage innovative companies. So it's not just a bank-centric system. We've got a very highly evolved,
I'm really not even saying much, but I'm just saying. I just want to wait on the
plenty of other reasons
retest.
that are worth mentioning, I think.
This is a double bottom, which I do like.
You gave a pretty clear signal, I think, that we're going to see a move.
All right,
in
I'll
June.
take it.
But a lot of the questions that people have put to us today have, stressed this point of, usually there's been this sense that the ECB has been following the Fed, and it's raised a bit of a question mark as to what degree
This is about
the policies of the two major global central banks, with apologies to the Bank of England.
I like when this MACD is
how much
going with
divergence
us.
can we really see? So
Even though
to what extent do you feel
I didn't mean to move
constrained
that,
by
but
what
because
the
we
US
moved
central
that, I'm
bank
going to
does,
just
and
look to see
would
what
you
the.
perhaps be reluctant to cut in July? Should the Fed
If we break over
stamp at
previous day
rates as
high,
they
we
are
should
for
be
the
going
foreseeable
even higher.
future?
Look, I think if you talk about monetary policy of
I'm
big
all in the can.
central banks like the Fed and the ECB, that monetary policy always takes place in a global context. I mean, our markets are interwoven to a large
snap.
extent.
Oh, no.
At the same time,
Oh, no. I was about to say, we
have
edit? No, we're
clear
not edit.
domestic
But
mandates.
we got close.
Mandates that look on an economy which may be 10-50% open, but it means at least 85% closed economy. So much of our inflation is actually being triggered still by domestic factors. So what we simply need to do is
man, let's
construct
get
our
it.
our inflation outlook for the euro area. And yes, Fed policy is of course one factor that has an impact. And
Can y'all see the charts well? Because I know it'd be like up in there sometimes. We're up $6 now.
If the
That's
Fed were
good.
to run a tighter ship than we were going forward, then probably that would lead to some dollar strength and euro depreciation, which of course leads to
These
additional
contracts
imported
got up
inflation.
to
But at the same time, you will also
$1.
have spillover effect through global financial
We
conditions.
do have to get past
Bond yields
97, and it looks like we're
internationally
going to
are
do that.
also
We're at
moving,
97 now.
in tandem. If you look at the last,
See, that's why I like to
weeks
look at it
and
on the
months,
1 minute,
bond
just to
yields
see
in
the
euro area
burst
have
and
gone up
stuff.
significantly without there being a true euro area reason for doing that.
Like, if
Of
we
course,
don't keep going
there's
past
spillover from
09s,
the
like,
US.
what?
And that effect is, of course, disinflationary. So if you look at the two effects, it's not so clear which of the two will dominate. And it's therefore also not so clear whether the developments in the US will really have a meaningful impact on the inflation outlook in the euro area. I don't think it will change the direction of travel in the euro area that much.
So you'd be willing to cut in July too?
Well, we've been saying all along that we follow a data-dependent and a meeting-by-meeting approach.
Well, I'll
And
sell
I keep
one here.
repeating here, it is essential what is happening
Nah,
in
fuck
the
it.
labor
I'm going to
market
hold it.
in particular, because services inflation is still the main remaining driver of inflation in the euro area. So we will simply
We in
have to follow
522s.
the data as it comes in, both on underlying
Let's see what we
inflation
do.
trends, So the labor market,
we got the
et cetera,
528.
and that's why there is no commitment beyond June. We will just follow a meeting.
I always be
meeting
regretting talking
and a
about like I didn't
data-driven
hold it,
approach.
blah blah. So I'm
And
gonna try to
data,
hold it.
when it comes to the
I
labor
got like
market, it's
nothing to
really
lose.
about the comprehensive assessment of the labor market. It's too simple to just look at sort of contractual wages. Contractual wages are coming down, but one of the problems now is that we
Literally.
have negative productivity growth in the euro
We got
area.
nothing to lose,
We have
bro.
negative productivity growth in Q4. In Q1, again, it seems as if growth in employment exceeds growth in GDP, which means that probably next week we will get another negative productivity growth number. And that means that unit labor costs are actually still going up. And then the question whether profit margins are capable of continuing to absorb these unit labor costs, that's something that we really have to assess over time when we decide on future steps. So nothing, no commitment whatsoever, open mind for anything beyond June.
And just to turn back to the issue of US inflation for a moment, you know, even
I'm
though the systems
expecting
that
a
we
little,
did
you know what I'm
see
saying, a little
remarkable
dippy
drop
dip.
of inflation last year, because it was
It can
you know,
cut
just so
too.
aggressive the
I'm
year
expecting
before
that.
that there is this sense that you know there's still a public
But we're
perception
gonna
that
thug it
prices are
on
very
through.
high. How difficult is it to really feel as though you can keep credibility at times when
Oh,
trust in
we're just gonna
public
go for it now.
institutions is under siege? And that's from Jeroen Broekman, who's from Leaders in Finance.
Go for it
I
then.
think for central banks,
Tell 'em.
credibility is kind of everything, and we only earn that one way, and that's by achieving our mandate for the benefit of the public over
Bro,
time.
go
And also, no doubt,
522.67.
a part of it
We
is
cut
sticking to
one
our
for
knitting.
sure.
Don't take on political
522.67. We
make
cut
about
one
our
for
mandate.
sure, and then
Do
we
your
let
job
the last one
and
go for break
explain as
even.
best you can what's happening in the economy. Of course,
And
the
then that's
economy
a
is-
W
the
day, man.
post-pandemic economy
Because
has
either
surprised
way,
everyone. I wouldn't single out any single central bank or
yeah, bro, that's a W day
forecasters. It's
right
just
there.
been many things that were not supposed to be able to happen have happened. Nonetheless, we've made real progress on inflation. We're far lower than we were. I would say the risk that at the beginning we were very concerned that the very high inflation we saw might be quite difficult to bring down without
Okay.
a kind of very significant decline
So,
in employment and weakening economic activity. That didn't happen. That's just a great result. I think people are unhappy. You mentioned people are unhappy that I fully appreciate.
Dude,
And a
just
big part of it, I think,
go.
is go to the store. Prices are high. You tell people inflation is coming down, and they think, I don't understand that. The price of all the things that I buy hasn't come down.
Oh my goodness.
They're not wrong. I mean, they're suffering. Particularly people at the lower end of the income spectrum are very hard hit by inflation from the start, which is why we're so strong.
This is a W trade though.
Restoring price stability.
3 to
and
1
keeping it
risk.
in place as long as possible.
And just to turn back to Europe now and to the Netherlands in particular, we're sitting in a venue
Alright,
here
I'm gonna
that's
cut
really
one because we're
testament
not.
to the power of trade for good and
Actually,
ill.
hold on. I'm gonna give it a second.
In an era of
I know we can cut it a little
deglobalization,
bit.
when we're seeing daily headlines about tariffs,
This is healthy.
how does the Netherlands as a small open economy, and indeed the Eurozone as a very trade-dependent region, really thrive?
We might see all-time highs today if Powell
that's
keeps
a
it up.
difficult
Yeah, that's what I'm
question.
saying,
It goes
bro.
beyond saying, that
And then you got
this
the
is a
meme stops
development,
going.
That is absolutely not
Look,
a positive.
I bet the meme
development
stops
for,
are going even more.
The euro area
Meme.
that we watch.
I can't even
with
talk.
a lot of
The
concern.
bleep.
Now,
I did that on purpose.
fragmentation
Look, but
is
see,
there.
they going.
Trade has left the station.
Oh,
so,
it went.
I mean,
So you
we
must have
to think
made
about
some bread.
the ways
Listen,
that
listen.
it can manifest itself, and what we can do to try to best redress its consequences.
You made what? You made 5,000 off of
There
one?
is a sense that
How?
international business is actually, to some extent, more resilient
Yeah, you need to explain that in the
fragmentation than
chat.
we have been
I don't
thinking
really get that.
beforehand. So that
You must have
international
held it or
trade is a
something.
little bit like a river that
You-
sort
you
of
bought 'em
attempts to
yesterday.
find its way, even if some obstacles are being raised here and there. But of
Yeah,
course,
that makes sense.
the
I already figured that out.
fragmentation, it impedes the diffusion of technology across borders. So that means lower productivity growth.
A retest in this
everywhere.
area, I would
I
like.
would also not underestimate
But then again, we
the
fucking did that
limitations that it
here, and
puts
then we
on our
cut even
capacity
more.
jointly and internationally to solve global problems. In a fragmented world,
I'll have to check that out in
we
a
had a global
second.
financial crisis again, like in 2008, 2009.
Yeah, good thing we're only like
Much
$20
more
away
difficult
still
to get
though.
the G20 around the table and to agree on a concerted remedial plan,
but
as we did in 2008,
this flag looks
2009.
good.
Think about climate change, etc. What can we do about
But we
it?
kind of
I
need to
think
start
in
going.
Europe, there is still a lot of untapped potential to at least strengthen our internal cohesion. We're not tapping the full potential of the single market. In many, many places, the single market only exists in a name. We don't have capital markets union. I think we are really doing ourselves a disfavor. We don't have a banking union yet. And so we are missing out on opportunities to strengthen international trade, or sorry, inter-European, I should say, trade and integration, economic as well as financial.
Would you have anything to
All right, we're
add
listening
on
to
this
Federal
topic?
Reserve
I know it's
Chairman
something that's
Jerome
featured
Powell
in
and
the
ECB
Fed
Governing
minutes.
Council member Klaus Knot speak at a special event organized by Netherlands Foreign Bankers Association. Claire Jones from the Financial Times.
This is a
moderator.
very, very hot political issue, not just in the United States, but everywhere in the world.
They're not trying to send it.
Trade policy, of course, not the job of the Fed. So, I mean, we, as I mentioned a few moments ago, I think we need to resist the temptation.
But every time
to
Powell
just
talks,
have
it be
opinions
going
on all
up.
different kinds of economic policies, as fun as that might be. You know, the elected government has to deal with these things, and they have to deal with the public on them. And they've given us really important assignments, and I think we need to honor the decision not to.
Yeah, they're trying to drop it.
I appreciate this is also an awkward topic, but it is, you know,
If this
is
goes
one that's
break even,
on
I'll just
people's
cut
minds
it.
a lot when it comes to the U.S. Fiscal deficits, in the sense that the national debt is forecast to rise by the Congressional Budget Office quite substantially over the next 10 years. Does that make your life trickier as Fed chair rather too?
I don't think it's not that it makes my life more difficult or the Fed's work more difficult, but I think it's you know, utterly non-controversial to say that U.S. fiscal policy is on an
See this woman on
path.
the
Not that our
let's
fiscal
make sure.
position
Let's
itself
just
is
make sure.
unsustainable, but the path.
The 5
is
minutes strong though,
unsustainable,
so it's like
meaning that
it
we're,
seems like
you know,
there
we
should
have
be
full
nothing to worry
employment,
about.
and
But we're cutting.
we're running big structural deficits, and it's, you know, we're going to have to
Shit
deal
looks
with this
good, though.
sooner or later, and sooner is a lot more attractive than later. I do hear from elected people on
shit
both
looks
sides of
good.
Capitol Hill and in both political parties that they do understand this.
Apple
And I
doesn't
think you
look
mentioned
good.
the Congressional Budget Office. I think anyone everyone should be reading the things that they're publishing about the U.S. budget deficit and the path, and should be very concerned that this is something that elected people need to get their arms around sooner rather
It's a
than later.
nice flag right there.
And you've noticed a lot, you know, you've noted a lot that these supply side benefits that you know,
Tragic
thought
if
might
the
come,
Bulls broke
you know, in
that.
2021 or 2022.
But it looks
did
like we're
actually
still
arrive
going
in
down, so that's why I don't
2023.
believe
Now,
it.
what sort of benefits from the supply side do you think
Not
we could see in
yet.
2024 and beyond?
So I think we probably have realized most of the reversal.
But the
of
money
pandemic
comes when you
supply side
hold
effects,
it.
but not all of it. But I do think
Even
I think
through the
we get
pain.
more sort of the final parts of
why it's
supply
called
chains really
patience.
getting sorted out. As I mentioned, the surveys of businesses, they still say
Trying to act
there are
all
shortages.
wise.
They still say that they have a hard time
But,
hiring
hey.
people for that matter. So I do think we're still getting you know, very substantial numbers of people coming to the country and going to work. Let me add, immigration also not a policy that the Fed works on or has opinions on, but I'm just giving you the straight economics of it. People come in, they can get a work permit, they are getting work permits, and they go to work and they're paying taxes and they're creating economic output, and there are millions of them. So it's alleviating the labor shortage that we had in the industries that really had it the worst. So I think all of that it probably helped at the margin a little bit in cooling the labor market off. It's both supply and demand, but we think at the beginning, in the longer run, it should be neutral on inflation, but in the short run, it might have been positive. So I think that's a factor too.
And just to kind of tend to these like broader demographic trends, there's been a lot of talk in recent years about how they will impact inflation, whether they have some sort of impact on R star, the kind of, you know, the Goldilocks level of interest rates in the longer term, one might say. I mean, how do you think about these kind of longer term demographic trends and other factors and how they're going to influence where you see this kind of magical Goldilocks neutral rate of interest?
So our star, for those of you who
just
central bankers who read every word of every story Claire writes about us, our star is really a longer run concept. Our star is a neutral interest rate that would neither push up on economic activity nor bring it down at some hypothetical future time.
We do not
when we're at full employment, we're at 2%
like
inflation,
that ever.
and there are no shocks.
I mean, not ever,
economy.
but
So
like,
think 5-6 years down the road, there's this sort of nirvana out there.
No pain,
its
no
relevance
gain.
for current policy
saying.
making is kind of limited.
I'm about to
you
get out
need
of
to
this
say
place
that.
right here.
Really, what we're doing in
I
an
don't think
FOMC
Powell said
meeting is we're
anything.
looking at the broad effect of the things that we're doing on the
I
economy.
think they're trying to
We're
shake
asking
people, bro.
ourselves, is
Because
policy
every time they
tight
bring
enough?
it
Is
down
too
here,
tight?
they
We're looking
just
at
buy it back
what's
up.
happening in the economy. We're thinking
But
about
that
lags.
5 minute
And
was being
it's not a
weak
debate
last
over
time
the
they did
level
that.
of
So
our
maybe
star,
it's
because
for
that's a
real this
longer run
time.
concept. Now, and the argument is made that our star will go up, and this is a debate that economists have been having for some years now. But the idea is, between deglobalization and the need to fund the energy transition, and perhaps the need to
I couldn't even
spend
sell
more
that
on
in time
military
before it
and
went
the aging of the
past
population,
break-even.
bigger deficits, higher. All of that could
Wow,
push up.
okay. So we obviously
what is a
want
neutral
to
rate?
sell.
And I think those are interesting debates to have. But ultimately, we're not sitting around wondering what the
429.5.
longer run neutral rate is when we do policy. When we make policy, we're thinking today, is our policy delivering what the economy needs to move it toward the mandates that
So we
Congress
just
has
broke
given
high
us:
to
stable
break the
prices, maximum
lows.
employment.
So would you divorce it? I mean, I think why this has come into focus, if you like, is because now that cuts are being considered in some parts of the world. At least there's this sense in which people are thinking, how low will rates go? Would you see that as part of the kind of R-star debate, or would you want to divorce the two factors of this current cycle and where?
This is weird
R-star
price
will
action.
end up being?
I think the R-star debate runs in the background, but again, it's a longer run concept. You could, if you wanted to think about a shorter run R-star, that would be more relevant. But that's not the way we think about it. We think about the effect of the things we're doing on financial conditions more broadly and on the economy. And how is it affecting the economy? And
it's literally the worst case scenario.
And and all of those things lead us to believe at this time that policy is restrictive, and that it looks like it will take longer for us to become confident that inflation is coming down to 2% over time.
And how is this debate occurring around the table in Frankfurt at the ECB about longer run interest rates, or even where are we going to end up? What's the rock bottom for this cycle?
Yeah, I mean, that's of course a difficult question to ask, because there are so many moving parts here. But what I would say is that if you look at the likelihood or the likely nature of the shocks that will hit us in the future.
Yeah, I really don't even got no buying power, bro. So it's like no point.
A period in which we had globalization, which was a slowly moving positive supply shock, ever more goods for ever lower prices coming from the rest of the world, which meant that for almost 10 years we continuously had to approach our inflation target from below. We had a low inflation problem. Going forward, with fragmentation, with aging of our societies, in my view, it's more likely that the shocks hitting our economy will actually be of the nature of negative supply shocks, not positive supply shocks. And if you think that through, that means that probably we will have to approach our inflation target more often from above than from below. And that probably suggests that we are not, at least I don't regard it very likely, that we will move back to the time in which we had a continuous sort of our fairly persistent low inflation equilibrium with very, very low interest rates. We probably have to, on average, run a slightly tighter ship because of the nature of these shocks that are currently relevant to our economy.
And just to come back to something that I think has been kind of in the background here for quite a lot of the discussion about high interest rates taking possibly a while longer to have the desired impact on some pockets of the economy. How do you see that? Is this a legacy of this very low interest rate era? And how do you really address that when it comes to monetary policy, that is there just going to be this lag from now on that didn't exist?
This is weird.
Relative to pre-2008.
So I think if you look at the bigger picture, we've seen the labor market's a good place to see this. You've seen demand for workers cooling off pretty substantially. The ratio of vacancies to unemployed people, for example, has gone from more than 2 to 1 to now 1.3 to 1, and it was 1.2 before. So that's a decline in demand. That's demand related. You also see wages coming down. You see quits coming down. So I think that tells you that policy is probably restrictive. I think it's also fair to say, though, that the U.S. economy is different this time for a couple reasons. One is that people financed themselves into very low-rate mortgages, and now they won't move because they would be moving into a higher-rate mortgage if they did, and they would be throwing a lot of value away. The same is true of businesses, many of which, as indeed you would expect, have termed out their debt. And so they're not feeling the effects of interest rates. So it may be that,
but again, I think
policy is hitting the economy not quite as strongly as it would have if those two things were not the case. Notwithstanding that, I think the overall picture still is policy's working. It's weighing on spending. It's weighing on interest-sensitive spending, and it's certainly weighing on the labor market. It's a question of restrictive policy.
This might be the real
as I mentioned,
move
our
right
policy
here.
is the highest it's been in quite some time. The rate is, at 5.25% to 5.5% is high relative to recent history. So we think that it's probably a matter of just staying at that stance for longer, and that's how we're thinking about it.
And I mean, you note about housing and about the standard model in the U.S. being I think I'm right, the 30-year mortgage is kind of the standard mortgage product. I think here in the Netherlands, flexible rates are quite more fixed rates.
Yes, absolutely.
So fixed rates are quite common too.
Damn, that's crazy.
With
That
shorter,
is
10,
shorter
15,
duration.
an average mortgage, I think,
like
has
that.
an average maturity of like 16 years.
It's all right.
Of course, that's a
We
little
managed
bit
to risk them.
homogeneous because of the low interest rate period we had for so
Imagine if
long.
we had a
That,
fucking
of
easy
course, mortgage
position.
holders tended to extend the maturity. So now, lately, it's been coming in a little bit. But still, we have a lot of fixed rate borrowing in the Netherlands, and that has, of course, also mitigated the impact of the monetary tightening, which has been stronger in those areas where there is more variable rate borrowing. But in general, I would say 85% of all financial intermediation in the euro area runs through the banks. So when you look at monetary transmission in the euro area, you have to look at credit. And credit growth has more or less come to a halt. As a consequence, we increased policy rates by 4.5% within 14 months. Credit growth came to a halt. That was a feature of the policy, not a bug. And credit has been flat for quite a while. And now we're also beginning to see the first signs of life again. Now that there is an anticipation that our next interest rate move will be a reduction of rates. You also see the first signs of recovery in credit. So in that sense, I think this is more or less how you would expect monetary transmission to take place in the euro area.
And how much of an issue has that been for you in the U.S. where we do have this?
ECB Governing Council member Klaas Knot speak at a special event organized by Netherlands Foreign Bankers Association. Claire Jones from the Financial Times
At the turn
is
of the year,
moderating.
the markets were predicting, 6 interest rate cuts by the Fed, and pricing credit off the back of that, and they're being quite
that's just
quite
crazy.
a big,
I don't know,
quite
man.
substantial growth in lending and refinancing over the first couple of months of the year. How much more difficult does that really make
So I
your
think,
task that the banks aren't as big a vehicle?
for what it's worth, it's a minority of intervention, but banks are still important, and particularly for small and medium-sized businesses that don't have capital market access. And credit has been tighter for some time now, particularly in the wake of the turmoil we saw earlier last year. But still, credit growth has been modest, and that's another sign of tight financial policy. So that's part of the picture. I think the fact that we have capital markets are so important for many consumer loans of various kinds wind up in the capital markets or securitized and are not held by banks. It's just it's a very healthy credit machine for people, but they're feeling these higher. Those are short-term interest rates. I think that, you know, the ones that are longer-term interest rates are the ones where they're not feeling it, and that's really mortgages, and that's companies that have turned out their debt. I think
also getting on like other patterns too that I see like pretty often.
The surveys show that people think it's not a good time.
So like for example, if this was to break down,
cars
this would be a
and,
cup and handle.
Washing machines.
It's not
and the
clean,
reason
but
it's a
it's
floating rate
a
loan
cup
at a
and
very
handle.
high level.
Absolutely. And when you look at the banking system as a whole, you know, we've seen some jitters, I think, on both sides of the Atlantic, but you know, on the whole, it seems both systems are relatively stable, despite, you know, quite substantial rises.
Maybe
in interest
Apple
rates.
was giving us
Has
a
that
warning, but
surprised
like
you at all?
most
Maybe
other,
first to Chair Powell and then
not most, but the other
President
tech.
Trump.
Has it surprised? Not really.
It's not
You know,
doing
our
super
banks
well, but it's not
are,
like doing
particularly our
bad. And then
large
Tesla
banks
like
are,
keeps
you know,
selling off.
strong,
and
well capitalized,
I don't
very
know.
successful.
Maybe it's trying
globally.
to chop again.
You know, they're in a. I think one of the.
It's like got
reasons
volume, but it's
why the recovery broadly around the world from the
weird.
pandemic has been strong as opposed to the one from the global financial crisis is that the very large financial institutions came through just fine. The U.S. banking system overall is in good shape.
Yeah, that break
Banks are making
520
loans, as I
60.
mentioned.
I'll take the put.
Credit conditions are a bit tight, but that's part of our policy. So I wouldn't say I'm surprised.
I just saying,
think,
it didn't look like a
you know,
fire.
we obviously had a period of turmoil early last year, and we acted pretty quickly to stem the turmoil and also to, you know, to go to work as a supervisor and make sure that banks had good plans on liquidity, had capital, understood the portfolio losses that they have for longer run securities, and are in a position to understand and manage those.
Well, I think it's pretty clear that if you have such an unprecedented rise in interest rates in such a short period of time, that this constitutes a massive shock to the financial system. So when we were sort of in the process of tightening, of course, this was sort of enhanced monitoring, an area for enhanced monitoring. Now, I think we can say so far so good. I entirely agree with Chair Powell that the core of the financial system has held up quite well.
Crazy,
and I think this is in part, I think the success of the financial reform agenda that was rolled out after the global financial crisis under the aegis of the Financial Stability Board, which was very much focused about stronger capital, stronger liquidity, stronger risk management at the banks, which were at the core of the financial system. And that has clearly paid off. Now, there have been some idiosyncratic accidents here, the second-tier US banking system, Credit Suisse, but I think there were idiosyncratic factors behind it. The banks that had arrived into trouble in the US part of the Basel III arrangement and the financial reform agenda. But I would say so far so good. The question marks today are much more in the non-bank financial intermediation space, where we have seen a couple of quasi-near-miss accidents, I would say. The Dash for Cash, the LDI, the Archegos, the commodity traders in February 22. So these have all been pockets of vulnerabilities where you saw a combination of excessive liquidity mismatches combined with pockets of hidden leverage that we were unaware of before. And that is now also front and center of the work program of the Financial Stability Board, much more the NBFI space. Of course, we have to learn the lessons from the few banking failures that we did see, and that is continuous maintenance. But I think if you were to ask me, my main focus is more on the NBFI space than on the banking space.
We'll come back to Credit Suisse because I know that's a topic that you've spoken about quite a bit, and a few of our audience have got questions on that. But non-banks, would you share that? You know, that sense in which they're the big lurking danger in the financial system right now?
I guess I would say it this way. In the U.S., non-bank participants by non-banks in lending activities, for example, has been growing very, very fast.
Ouch.
And it's a fairly new thing. And in many cases, whole markets are being now taken over, or now majority for non-banks. And so our job is to monitor that very carefully, because I'll say a couple things. One, there hasn't been a downturn yet. You worry about very fast growth in anything. It just kind of raises financial stability questions, and you wonder, is it a bubble? What will happen when will it deflate and that kind of thing? And so you want to be watching it carefully. I will say though, it's different. You know, some of the we've spent a lot of time looking at it. I would just point to a couple things. One is many of the lending structures are not.
Oh, we did just reject off the VWAP. I didn't even realize that.
Traditionally been the funding tends to be from limited partners who have their investment locked up for many years, and they can't get it out. So as opposed to the danger with a bank,
I like when we come down here
want their money
for
at the same time.
to take
and
calls.
that's
Yeah, that was
traditional
just dumb of
problem
me
that
not
we've
to
tried
take no
solve with
brand.
bank
That was just
regulation
stupid.
for hundreds of years. But
Taking no brand.
these are
at all.
different. They don't have, and runs are responsible. Bank runs or things like that are really responsible for an awful lot of the problems that happen in one form or another. So the non-bank financial sector doesn't have that as much. Another thing is the ties between banks and the non-bank financial institutions are substantial and growing. So there's plenty of monitoring for us to do there. It's not obvious to me that at this point that it's a net loss to financial stability, but I would say our jobs are to monitor it very carefully and thoughtfully and understand the implications.
And just to return to the topic of Credit Suisse, we had a question submitted ahead of the event. In your keynote speech at the 7th Annual Conference on European Systemic Risk, you talked about events surrounding Credit Suisse. What can the Foreign Bankers Association, to which we're speaking today, and the Netherlands Bank learn about the collapse of the Swiss lender?
Well, I guess
we gotta get over this trend, bro.
Because the most important is the huge importance of governance, governance within financial institutions, because it is pretty clear that the events that led to the failure of Credit Suisse were not sort of a classic lack of capital or, let's say, too much credit risk relative to the capital. It was management failures, there was outright fraud, there were misinvestments, there was misbehavior.
Oh my gosh, they're trying to make it seem like
at the top of the institution.
All they did was
and if you have a series of governance failures at an institution, it will lead to an erosion of confidence. That erosion of confidence will lead to deposit runs, which, by the way, already took place much earlier than March 23. There was already a significant outflow of deposits also in the fall of 2022.
We're striking out, man.
We have to remind ourselves, it is not only about capital and liquidity. Governance of financial institutions is of utmost importance.
And are there any questions about AT1s and the treatments of those particular instruments that you think can be drawn in the Dutch context?
Yeah, of course, there was a case where AT1s have been completely written down. So I think it behooves us to look a little bit deeper into this issue. Why the AT1s were drawn down, whereas equity was not fully written off. This was, by the way, completely in line with the contractual provisions of the AT1. It was just that not all investors had really read the contractual provisions, so they pretended they were surprised by it. But I think from every case, I think we should try to draw some lessons. But in this case, at least, it allowed the authorities to write down 16 billion Swiss francs, which was helpful to generate the interest of UBS to actually take over.
And now turning back to you, Chair Powell, we've got a very nice question here from Liu Zhan from ICBC, who asks, during COVID, the Federal Reserve applied high levels of monetary stimulus to further raise asset prices and support growth. Bloomberg called you Wall Street's head of state as a reflection of how strong your actions were on asset prices and how profitable your actions were for Wall Street. How does that make you feel? And how do you look back at this with the benefit of hindsight?
It makes no point of contact with the way I remember those days, so whatsoever. So I would just say this. If you put yourself in the place where we were in March of 2020, we were no one knew how long it would take to have vaccines. No one knew whether millions of people were going to die fairly quickly, or how long the economy would remain closed, or was it even going to be possible to reopen the economy if it had to be closed for a year? What was that going to look like? So I think it was so uncertain.
It's looking like if we don't get no volume, I'm going to die on
that we
these.
really needed to use our tools
Die on the sword.
in ways that we hadn't before, because I would never have been, if things didn't work out, I didn't want to, if we had to go through a really deep, lengthy downturn, I would not want to have to explain why we didn't do that. So we did, and what happened is we announced these very aggressive, vigorous programs to support markets that we had never had to support before, the municipal market, corporate debt, these were red lines that we said we'd never cross. But the thing is, when we made the announcements, the markets healed themselves. So we made very, very few loans. We had something like $6 trillion in lending capacity. So the announcement effects of the things that we did, it really worked this time. So I think, broadly speaking, that the initial response was very successful.
All the way back up to 522.
Ultimately, very, very little in the way of actual lending. A lot of announcements. Then the story goes on, and you have the reopening and the inflation, and
all the way
through that. I think we'll have to
do not
that
stop
from a greater distance.
Anything you'd do differently in retrospect?
There's nothing I would do differently in the initial response. I think we did very well, and I think that the world continues to benefit from the strong response that we took, and we really avoided an awful lot of a bad tail risk there that could well have come due. Again, I would say on inflation, when inflation kind of unexpectedly arose in first quarter of 2021, I think we're going to need to. I've tried to resist reaching conclusions about that episode until it looks so different now than it looked a year ago, for example.
Yeah, but after this
progress
trend getting off,
2023, I think we're talking about it in a completely different way now. I think 2-3 years from now we'll be doing the same. So I don't want to try to learn lessons, in the middle of the story.
Nice.
Yeah, it's very fair. And another question here that's just been submitted from Abir.
Holy shit.
Is
No,
Chairman
bro,
Powell
see, I'm sick. I
confident
sold
about
that
the
stuff
degree
for
of
what?
independence of the Federal Reserve in relation to the executive branch
I
of
do want
government?
to see if this is possible.
Do you think you have the
Can we
powers
get
that
to
you
55?
need to defend your independence?
Yes, without question, I do. I think when
This is 35.
I talk to elected representatives in both political parties in the House
We're
and
at
the Senate.
68.
I think there's very strong support on both sides of the aisle, on both sides of Capitol Hill, for an
73.
independent Fed. I think people do understand that we're just there to do our job on a non-political, non-partisan basis. Nobody's perfect. Everyone makes mistakes.
If we can burst
but
through a little more
Fed is doing
with
the
this,
absolute best we can
73.
with the tools that we have and the understanding of the economy that we have. I think that is very broadly understood and supported on Capitol Hill. So I'm less worried about that than the sort of things that have been in the press lately might suggest.
The same question to you. Do you feel as though the ECB's independence is well enough enshrined?
Oh yes, I think the ECB has one of the strongest statutory independencies of maybe all central banks in the world. And let's zoom out just for one moment. I mean, this inflation shock that we have, if you compare it to the previous inflation shock of the same magnitude, which was in the 1970s, when we didn't have independent central banks, the main difference why I think now we have a credible prospect of getting the problem under control within, let's say, 3 or 4 years,
right now.
While in the 1970s it took 10, 12 years, and the disinflation was so much more painful. The sacrifice ratios were so much higher, high unemployment, etc. The big difference is central bank credibility. During this huge inflation wave, inflation expectations continued to be well anchored. They never drifted away
look at these
from 2%.
candles,
This is
bro.
so different to the 1970s. And why were inflation expectations so much better anchored this time around? Of course, that you can have a debate about it. It's about psychology, etc. But I would posit that the higher degree of central bank independence is clearly an integral part of that story.
This could be the right shoulder
this is a
too
very
for it to go
tangible
down.
way in which we can show to society the benefits of having independent monetary policy making.
Would there be anything that you'd like to add to that on the case for central bank independence?
Yeah, I think Klaus said it very well. I mean, I think in the United States we don't have quite the constitutional, I think, support that you have for it. It's a statutory arrangement. It's an institutional arrangement that has benefited the public, and that's all it is. Congress can change it any time they want. It would take Congress to change it, though. There's nothing the executive can do. And again, I don't think that's likely, but as long as what we're doing is keeping our heads down, working on the things we're supposed to be working on, doing our absolute best, and explaining ourselves as best we can, acknowledging
This
mistakes,
is dying rapidly.
and going forward, and that we will have the faith in our independence that we need, and I think we do have that now, and I'm determined that we'll continue to have it.
And I think that's a very suitable note to end this discussion on. I'd like to take this opportunity to thank the Foreign Bankers Association for putting.
Bro, we about to sell off again, bro, like that?
Federal Reserve Chairman Jerome Powell and ECB Governing Council member Klaas Knot speaking at a special event organized by Netherlands Foreign Bankers Association. Claire Jones from the Financial Times was.
Wow, what is this day?
The broad discussion from Fed Chairman Jay Powell.
This clown
yeah, you had a lot
world
of
day,
headlines that
like
crossed.
what the
Not necessarily
hell?
anything that moved the needle, but just more of how
Nah,
Jay
just
Powell and the
we
Fed
have to
sort
pull
of
back a
thinks
little bit.
about things. He commented on today's hotter than expected PPI reading, said
But
that
I do
it was
guys for this
mixed, and
contract,
he
so
wouldn't
this
call it
can't be
necessarily
taken too
hot.
long.
He did make the point that you might have to see restrictive rates and they might take longer to work. He definitely said service inflation is one that would take the longest. He kind of ruled out a hike. So kind of steady as she goes, and talking through how they think of the economy, and still kind of doubling down like, yes, monetary policy is restrictive, just look at the job market. That seems to be their line.
Okay. I mean, I like the Bloomberg News reporting doubling down on the need to keep borrowing costs elevated, so that's pretty clear. Let's check in with Ira Jersey. He's Chief U.S. Interest Rate Strategist for Bloomberg Intelligence. Again, Ira, I guess Fed Chairman Jay Powell will give him points if for nothing else he's consistent. What did you take away?
Yeah, very consistent. I mean, I think the important line was he hinted that they would just remain on hold for much longer as opposed to hiking interest rates. So, we have to, even though the market was pricing in some risk of a hike by the end of the year, he's basically taken that off the table and just said, look, we're going to stay on hold for longer if we have to and not cut, but we're not, next hike is probably not going to happen. Interestingly, we concentrate on the Fed here, obviously, because we're a U.S. based organization and radio station. But I think some of the stuff going on in Europe was pretty interesting, and that was noted, including basically the idea that they pre-committed to a cut in June. So in a way, that might actually make the Fed's job a little bit more difficult, because if you have the ECB easing
I ain't saying nothing, bro. I'm just humming. All right, so look. What I'm looking at right here is this 5 minute breaking over 521.90s and continuing on this bullish continuation. Simply because this is starting to curl and create a flag, and it is respecting the moving averages. And on the 5 minute also, you got the MACD going from red to green, which is very good for calls. So that's the end of my TED Talk, you know. But I do like the 5 minute and the 15. They both look really good. And then this can still go up right here, pull back, and then go even further. So it might be, these XPS contracts will not survive something like that. So you kind of want this to go, but I'm just keeping it a buck. That's how I'm gonna look at my bank account in 5 years. I'm gonna cross that Billy. No. Yeah, funny. Ooh, comes a fun. That's what I've been humming when I was muted. I don't like that this is green and going down, but we'll see. It's got 5 seconds. Do we break 80s? Okay, so they gotta go towards 90s, confirming that flag break. We are already technically moving up on the next 15-minute candle though. So that's good, I guess. What the fuck? Ow, 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 ow. 77. Damn, having the 3 charts is kind of fire because then I can see the 1 minute at the bottom. I really feel that this has room to go up. Let's go. I really like this flag though. Flag is decent. We're over the train. My back is hurting. I got a lot of resistance up here though. $78. They got you, boy. Five minutes of starting to build to. Just saw 81 there, cool. $84, $85, nice. Alright, I want to see where these contracts are kind of at. So they got to get back to 60. And then they're going to get to 178. And then they want a milkshake when I'm not in it, but wanna let the shit run when I'm not. What? Guys, I am sick. I really just sold for no reason. And I probably would have been down a little bit still. I'd rather be down a little bit. I don't even think I could have added, unfortunately. Bro, look at this 30-minute right here. If that don't tell you something right there, like, yes, retest on top of the trend. So we doing that shit again. Okay. Okay. I see. I see. We're doing that. Excuse me. I think I have to cut this simply because, man, this is gonna play. Sorry. I'll just take the L on that. I'll catch y'all tomorrow and try again. It's all good. Peace.